Joining us here at Post 9, Citi U.S. equity strategist Scott Chronert. He's got an S&P year-end target of 4,000. Given what we're seeing right now, does this rally have legs? Do you stick with that target?
I mean, this is the narrative we were hoping for going into Q4. We knew that sentiment was very stretched to the negative. You could see that in the options and futures positioning. And so what we were looking for as a catalyst was either some combination of more resilient Q3 earnings, which early in the reporting season I think we're getting, and or some tone regarding interest rates that we're looking at peaking Fed hawkishness. So I think the combination of those two kind of sets this up. So we're keeping an eye on yields while we're also keeping an eye on the earnings picture.
Okay, so how does that take us into 2023? And I asked that given the comments we got from Goldman Solomon, some of the other bank CEOs in recent days, with the exception perhaps of Brian Moynihan, that there's increasing likelihood or risk of recession here next year.
Well, it's our base case. So the question is it first half, second half? We've been in print since the mid part of this year. That's probably a first half situation. So what we have to expect off of that is that the bulk of the earnings pressure on expectations and earnings reality is probably more first half of next year. And that's just paying attention to natural lead lag effects between where the economic indicators are taking us and the read through to actually earnings, which tend to lag by several months.
We had John earlier in the month and we talked about you, not your base case, but upping your odds of a severe recession. Has there been anything since in the last 2 or 3 weeks that's ratified that scenario?
I think it's still out there, right? So we're at 20% odds of a more severe recession, and that narrative is always around economic activity rolling and the Fed continuing to tighten into that in this quest to get inflation down. And what you get out of that is this risk of unintended consequences. So it's still out there, hasn't been alleviated, hasn't gotten materially worse, though.
Right. This housing sentiment number of 38 is a classic example of people pointing to a metric that the Fed doesn't look at, right? Because they're more interested in data that some say lags.
Yes. I mean, we have to be aware that clearly going in this combination of inflation effects and now rising rates, the consumer's the first place that you're going to feel this, right? Much more so than the production side of the economy. So I think what's happening in the housing market is just, it's sort of probably a really important starting point for measuring how the Fed is going to begin to assess the effects of their policies thus far before they continue down a ongoing tightening path that so many are expecting right now.
I want to go back to this idea of unintended consequences and just historically what we've seen in terms of consequences from a Fed tightening cycle that's been this aggressive. Has there ever been a time where the Fed has been this aggressive and it hasn't tipped us into a recession? And then when you layer on quantitative tightening, which in many ways is kind of a whole new terrain now, what does that do here?
So I think the quantitative tightening, the way we're accounting for that is that we're presuming it adds maybe a quarter of a point to what we would expect the Fed funds rate to actually, get to. Now, in terms of where this pops up, in my many years of doing this, this is the first the first time that we're actually looking at the Fed way ahead of recession possibilities, right? So usually it's in reaction. This is anticipation of. And so I think what we really just have to pay attention to is kind of aligned with what we're seeing in the housing market is where you get this rapid and aggressive of a Fed rate hiking cycle. Where are we going to begin to see issues that emerge? And like I said, we've gotten an example out of the UK so far, I would say, but not much more than that. Housing is going to be a first place to keep an eye on.
Okay, so just quickly then, where does an investor put their money to work right now? It sounds like maybe not housing.
Well, the way we're playing it is that we've gone down this growth path, and we think from this point going forward, the growth side of the market lends itself to two opportunities. The first is more resilient earnings, which historically you get going into economic downturns. The second is the possibility for valuation relief should we get to a market sentiment that begins to price in peaking Fed hawkishness.
Okay, Scott Chronert, great to have you here on set with us.
Thank you very much.